This episode is brought to you by Sablier, the leading on-chain solution for token distribution. You'll hear more about them later on in today's episode. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hey guys, welcome back to another episode of Lightspeed. Today I'm joined by Carlos from the Blockworks research team. Dan and Ryan Connor could not make it today. Busy, end of the year, deadlines, all that fun stuff. So it's just going to be a one-on-one, me and Carlos. You guys probably used to that by now, but how you doing today, Carlos?
I'm great, Danny. Yeah, it's a two-man episode, but let's ride it out.
All right. Let's hop into it for today. I guess we've kind of already spoken a little bit on past roundups about kind of views for 2026 for Solana. So it's not going to be entirely like a 2026 kind of prediction episode, but maybe some of that interspersed in. I did want to talk about, just to kick things off, I saw recently, I was looking at the ETF flow data for the Solana ETFs now that they've been out for maybe six months or so, if not more. And we've got, multiple issuers at this point. I was surprised to see, and let me pull up some of this data, actually. I was surprised to see that flows for the SOL ETFs have remained positive despite kind of, negative price action in the past 3 months or so. You can see kind of the decline in those flows since from early November, mid-October to today in magnitude. But maybe just another kind of interesting view here is comparing the flow amounts relative to their market cap and then against the BTC and ETH ETF flows. Interesting to see that there's been a bit more outflows and outflows in size relative to the Solana ETFs. I don't know, just an interesting trend here. I think I would generally expect, the majority of these things to kind of move in lockstep, right? When risk is on, we've tended to see as price is going up, then the inflows look pretty good. And then when price goes down, the outflows look pretty bad. And we're not really observing that here for Solana for the past few months. So sort of an interesting kind of countercurrent trend. It looks very inverted compared to the ETH and BTC flows of the past several months. Something interesting.
Yeah. For me, one of the key takeaways is that in terms of institutional flows, you kind of want to look at both ETFs and DATCOs. And for me, there has been a clear divergence since November between the flows from the ETFs and the digital asset treasury companies. So in late October, a second cohort of ETFs joined, like Rex Oxbury and Bitwise, and you can kind of see that on the chart where you have an uptick in ETF flows. November was the strongest month by far for ETF flows. We saw $420 million in net inflows, up from $128 million in October. This is excluding the seed amounts. If you include the seed amounts of the ETFs, that will be even higher. So for me, I agree with you, Danny. This is impressive, especially considering that both BTC and ETH saw sizable outflows during November, as we can see on the chart. And the other side of this is that there was no buying activity for DATCOs in November and almost no buying activity in December as well. So we can see that DATCO capital raising capacity has been limited by discount to market NAVs, as well as limited secondary market activity. So I think what we'll see in 2026 is that ETFs were the best vehicle all along to get institutional exposure to SOL's price. And I think we will see DATCOs continue to bleed out in terms of liquidity and buying pressure for SOL the asset.
Yeah, I do think that makes a lot of sense. I wonder how much, if at all, there's like going to be some ongoing interrelation or correlation between the DAT activity and the ETF activity. Probably hard to say. I mean, I guess it's possible that some DATs could be accumulating some of their assets via ETFs, but from what we've seen, at least from public statements and kind of what's been discussed, they're sort of tending to be like natively on chain, accumulating like spot assets and then like staking them themselves through providers. But I do think, to your point, interesting trend here to see for SOL specifically. I would tend to agree that, to have exposure to these assets, like the more obvious and more correct way of thinking about it is to just park it into the ETF vehicle that buys the asset and owns the asset as the underlying, and you don't have to mess around with this like active management idealism here and price to MNAV ratios that we've seen fluctuate wildly over the past 6 to 12 months now. That said, if you're interested in kind of playing that kind of premium to MNAV game, then this might be a more opportune time than when many vehicles were trading at 2, 3, 4, if not higher multiples. Now that we're seeing across the board, BTC, ETH, SOL, and other altcoin DATs trading at significant discounts to their MNAV.
Yeah, I agree there. Like, the last thing I'll say here is that when you're buying the ETF, you're just buying exposure to the price movements of the underlying. And basically, as an ETF issuer, all you can do is just like stake it and provide staking yield to the ETF investors. The one advantage that probably DATCOs have is that they can be a bit more creative with the things they do. So, as you mentioned, a bunch of them have launched their own LSTs, for instance, via Sanctum. And what they're trying to do is just to maximize the souls per share. And they can play with on-chain strategies, for instance, listing that LST on money markets like Camino. And then you can generate yield on that, or you can create like looping strategies that generate higher yields that you would otherwise do by natively staking. So there are some games that you can play for sure, but I do think that ETFs have existed for the past 20 plus years for a reason, and they're probably the most efficient vehicle to get exposure to the underlying price movements.
Yeah, agree there. I think, depending on an individual's goals, what have you, if you're just looking to invest in SOL the asset, for example, then the ETF is providing that to you. And what these DATs are doing is a bit broader in scope. And I think, you highlighted the LSTs, but I think we've seen, Forward and maybe some others mention building out, prop AMMs and other tooling like on-chain and like kind of various on-chain business components or applications alongside what they're doing with the treasury stack. So it's a bit more of like a diversified business kind of choice rather than just kind of passively investing into an asset. So I do think it's been great that the kind of fire around all the DATCO talk has calmed down quite a bit. We were definitely way too over excited about a lot of those things in the middle of this year with all those premiums at multiples to MNAV, and the discussion has become quite a bit more moderated as of late. So I think potentially we'll see kind of the few that can effectively like actively manage their stacks and maybe do some interesting things on chain do well from here. But there probably is also a big minefield of firms that sort of jumped into the game expecting, some quick returns and, with all the pipe deals and things going around, like, just sort of hoping for maybe some quick profit and jumping on the bandwagon there that are going to, potentially just bleed out or, return capital at some point, and it'll have just been like a bit of a wasted effort. But I think those few and far between is maybe where you'll have to look to find, interesting things over the coming years. Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axiom. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Jumping past the DATs, though, I think the big topic, big piece we wanted to talk about today, there was this short report article written by BQ Brady. I'm just going to share the whole thing and we'll look at some different parts of it, but talked about payment for order flow on Solana. And the really interesting part, I mean, he's doing some comparison here in terms of PFOF in traditional finance to crypto, or at least kind of where we're at today in crypto. And you see this in Solana to some extent, as far as we know, in terms of charging for market maker access. The kind of comparison here where if you're a user who's trading on something like Robinhood, you input your order and then behind the scenes, they'll get a quote from a market maker and have some, revenue profit sharing agreement to place those trades and take on that flow and share some of that revenue with, Robinhood, the broker who ultimately you, the user, are placing the trade directly with. In on-chain and on Solana, I think it's not quite so concretely in that form just yet. But he dug into the details here around the transaction fee market on Solana with priority fees and transaction tips. And it does appear that we're sort of like getting to this place where, transactions are submitted to, your Jito, your Nozomi, and then scheduled via, Jito Harmonic, your block builder. And a lot of the sort of front-end applications, if I just move along down here, front-end applications basically take these transactions from users. So if I'm trading on Phantom or if I'm trading on Jupiter or Axiom, like pick your favorite, it's, the user's placing a transaction there. And what we have now with prop AMMs and the way that most kind of orders get filled now is that you place the transaction. There's probably some aggregator that's then kind of like deciding whatever the best sort of transaction route is. Maybe you're getting filled by, prop AMM, maybe it's Humidify, maybe it's, Solfi, whoever else. They're ultimately kind of, filling that order for you. And then there's a little bit of like gamification in terms of the actual fees you pay from a priority fee perspective on that individual transaction. And the data that he looked into here, which is the interesting part, is around the priority fee data and among the different transaction landing services for addresses of, you could basically call them like differently typed addresses, right? If you've got a wallet with a few TXs versus a wallet with millions, you might be pretty confident in saying that one is probably a bit more organic and the other one is a bit more like bot-like or running some kind of automated service. And so he breaks out some wallet cohorts and then different transaction landing services. And the interesting thing that you find is that it's pretty common for lower transaction count wallets in sort of the like, if you call them the P99, if you call those like the maybe prosumer users, or it's much more likely to find addresses with extremely high priority fees paid on transactions on these lower wallet TX count, you see that here, addresses versus very high TX count, like basically automated addresses. And so basically, these bots or, sophisticated, if it's the market makers themselves that are running a bunch of transactions, they're optimizing to not pay a ton of extra priority fee. They understand maybe the limits of how much is actually applicable. And you see these sort of lower activity wallets spending a lot more. And when you break that out by the actual services, there's a pretty marked difference in which services see a big increase or like total amount of tips being paid for swaps. Nozomi was basically notated as the kind of highest swap tip receiver, especially per swap. So like we look at Jito and they've received 300,000 in tips over 24 million swaps, whereas Nozomi has received over 1 million in swap tips over only 2 million swaps. So a pretty substantial difference in the actual like kind of tip to swap count amount. And then finally, I think he sort of uses Axiom as a case study here to really make the point that there are some services that are basically overcharging users that are sort of unaware of the fact that they're wasting a ton of fees on these very, very high priority fees. So now you see here specifically for Axiom, the priority fee units, these big numbers are just priority fee units. So you're just kind of getting an indication of how high of an amplitude of a priority fee they're paying to make a swap, for example. And the P99s here for some of what you might assume are just, if they're using Axiom, it's probably like a generally organic user. They do have some automated services within the app. So you could be automating some trades, but if you're doing a few swaps on an individual address in Axiom, you're probably a relatively organic user. And it's interesting to find that one, these P50 priority fee units are, at $1 million for starters. And then the kind of the higher people further up along that curve are paying exorbitantly more in priority fees than what we saw kind of like generally for Solana users. So basically making the point that users on Axiom and probably other front-end apps are just generally overpaying by like a significant amount when it comes to priority fees.
Yeah, absolutely. Like just, I think summarizing here, especially for maybe if someone is listening and not looking at this visually, like what Benedict Brady does from Meridian is he's trying to show how wallets and apps monetize swaps, not just via visible fees, but through routing choices, background sales, and over tipping, right? So for this specifically, he used only data from December 1 to December 8th from Allium. And what he's trying to do is show like three parts of the transaction stack. So if you think about like the Solana transaction lifecycle, you have first the application, in this case, something like Axiom. You then have something like transaction landing services. So Jito, Nozomi, Helios. And then you have like the scheduler and the builder, right at the end. So the key conclusion, in my opinion, is that low activity wallets routinely overpay priority fees, even when the blocks are not full. So even when there's no like contentious state or whatever, like low activity wallets, which are basically normal users like Danny and I, are overpaying. And the reason for that is that the application is able to double charge you in exchange for like the perceived speed that you're getting. But in reality, you don't need to overpay for that much. So it's sort of like an invisible rent extraction that Solana needs to somehow overcome over the next year. I think like going into the conclusion of the article, like what he concludes is that user and app incentives are badly misaligned with payment for order flow like practices such as RFQs, DEX routing, and transaction landing services emerging on Solana. And I think like one of the key solutions that he proposes that is actually being worked on right now is multiple concurrent proposers, which is like the last part of the transaction stack that we were discussing. So right now you have like a single leader on Solana, but like in 2026, we can expect multiple concurrent proposers, and that can significantly improve that side of the like extraction, if you want to look at it that way. Another thing you can do is like have priority ordering based on specific rules. And that can also help with invisible rent extraction so that Solana can compete with traditional markets while protecting the users. I think we can also look like at Axiom's daily revenue so that we can also look at how much actually they're making on a daily basis, which is quite impressive.
Yeah, I wanted to pull this up. I know for a while the app was operating in the realm of $1 million a day in platform revenue. That being said, Axiom also does have significant kickbacks for trading volume. So I think their net revenues are basically half of their actual total reported revenues just due to all the kickbacks and kind of the referral fee kickbacks and different things that they do to incentivize trading activity. So you kind of have to take that top line number with a grain of salt. But despite that, they've still kind of become and remain the dominant sort of like, memes have fallen off a little bit, but they quickly usurped all of the existing like trading bots and trading terminal platforms on Solana over several months at the beginning of this year, and continue to do so, as evidenced by the chart. The revenues listed there for the trading platform revenue. I do think the interesting part of this, and I wonder, I think obviously their ability to just part of the story, I think clearly is that the default settings on transactions are probably just with absurdly high priority fee and tip settings from the get-go. And I wonder to what extent like there may be some path dependency here in the fact that, I think for there's been some back and forth at least around how effective higher priority fees are for landing transactions on Solana. And I think for a long time, maybe in 2024, I want to say, or even early 25, it was maybe I'm thinking of 24. It was like kind of effectively bugged, and it didn't matter how high of a priority fee you placed. It didn't really impact your landing or landing before other transactions on the network. I think that has been improved to some extent, but to the point of this article, there might need to be a little more education around like how meaningful is a distribution of priority fees versus your ability to land a transaction. I would imagine that paying 1 million units over 5,000 units, like you're certainly way beyond the point of a meaningful like point of paying a higher priority fee. There's almost certainly to go that high.
Yeah, I mean, like something that's interesting that just came to mind is that objectively, like Brady's right that Axiom is like double charging the users because it's not really necessary. And you could call it like invisible, like rent extraction or whatever. But like also objectively, like this is a case of what Ryan Connor will call how is it like stated versus reveal preference, in the sense that users do not actually care if they are paying like a 50 cent or like a 20 cent or 10 cent priority fee. I mean, they demonstratively like are willing to pay that. And I don't think it really matters from like a user perspective, in the sense of if I'm trading on Axiom, I'm demonstrating that I don't really care like if I'm over tipping. And it's sort of like the nature of the game of like trading terminals and like applications that are closer to the end user than purely like infrastructure like Solana. And I think like a good segue from this topic is like applications like are increasingly earning more than Solana the network, because they have all the power, in the sense that they are the ones who ultimately own the end user, and they have like the pricing power to charge or over tip on transactions. So I think we have like a great chart to show how applications have remained like more resilient in terms of like revenue compared to the network. So yeah, if we look at this chart, I think it's pretty impressive, right? Like if you look at REV has declined dramatically since the January peak. If you look at November REV, it was around $27 million. December is on track to be like about $24 million, which is like a 90% drop from the Trump's meme coin mania. The important thing here is to also look at the other side of the equation, which is application revenue, because application revenue serves as an indicator of success for businesses within an ecosystem. And Solana applications, if you look at like the green line on the chart, surpassed the network in terms of revenue in June 2024, and they have stayed on top ever since. So if you look back to June 2024, Solana applications were earning combined around $1 in revenue per every dollar in network revenue. Today, that is closer to almost $3.5 in revenue per every dollar that Solana generates in revenue. So a key question for me is, in terms of valuation, does valuation in the coming year reflect this increasing value capture to the application layer, in the sense that do applications outperform, or does Solana keep getting like this L1 premium from which other networks such as Ethereum, BNB, or Tron benefit? I don't know. What do you think?
That's a good question. Honestly, I don't know if I have a strong view at this point, directionally one way or the other, especially comparing these networks. Like, I do think, I don't know. I wanted to go back. Sorry, I was thinking still about the payment for order flow thing, and maybe just to go back to that for 1 second before we jump on. I saw that Keone actually added some comments to BQ Brady's post, and I think this is a pretty interesting train of thought here around. Basically, he lays out this idea of, front ends present users with a transaction to sign, so the user is always signing off on the fees they pay, but the users probably don't understand what's reasonable and will probably sign regardless. So this gives the front end a ton of power to overcharge for priority fees, a lot of which could or maybe is rebated to them if you assume that there's maybe some agreements with these transaction landing services, or kind of like tipping services that they're operating through or in connection with. Front ends can also add a kind of direct front end fee, but that's more obvious to the user. And so maybe they are basically disincentivized to increase their sort of native front end fee and incentivized to increase their sort of back end hidden TX fee or priority fee like settings to get higher hidden fees and lower front end fees. I don't know to what extent that's really true today. If I think about a lot of these apps, I would imagine still that the majority of the revenue is coming directly from the front end fees, especially with, like Axiom, even with the net kind of kickbacks, they're, a 1% fee is maybe 50 bips. That's pretty significant given the volume that they process. 50 bips on a couple 100 million in volume a day is very significant. Whereas, if you're doing a few pennies on a 10,000, USD total nominal value transaction, that's far smaller. But that could, gradually over time, that could become more meaningful if you see significantly, a significant increase in smaller transactions, and kind of a gradual decrease in the relative volume per transaction, for example. That's a possible future outcome. But then the last thing that he adds is it's much easier for front ends to do this with centralized landing services compared to if they had to arrange this with each validator. So it creates some perverse incentives here, where there, an Axiom or similar is basically incentivized to play around a little bit behind the scenes to optimize for some additional fee revenue that they're getting that the user probably doesn't really notice. Like, the numbers stated on this report are some of the highest transaction fees for like Axiom tips from Nozomi, for example, at this sort of like P99, the 99th percentile, are like $3. But if you're a user who maybe did a 10,000 notional transaction, you probably still don't really notice the $3, especially when you paid 50 bips on the volume. So, I do think in terms of volume, like it's certainly something meaningful. They can augment their bottom line there, but it's probably not meaningful enough for the consumer to really care. But is probably meaningful from a competitive standpoint for, maybe these different apps and service providers to be thinking about.
Yeah, I think you hit the nail on the head there. I think this is mostly an issue that very technical people see, but like neither the consumer nor the apps who is providing the service kind of sees it as an issue. Like the app is simply monetizing the best way they can. And the user is like obviously happy with the product experience that they're receiving. Otherwise, they will simply change apps. It's not like Axiom is making users stay on their application in one way or another, right? I think you see this like in all of finance, honestly, not just in like trading terminals. Like if you think, for instance, for people who don't live in a country like is USD denominated, and then they've ever had to exchange dollars for the local currency, like maybe the application or like the bank will tell you that they're not charging you any fees when you exchange dollars for the local currency, but they're like eating you up on the FX rate, right? So it's kind of similar here where they're not explicitly saying like we're charging you X amount for the trading, but like obviously they're hiding that somewhere. They have to earn. At the end of the day, they're a business, and they'll do it like the most UX friendly way possible, and like the way that the consumer thinks that they're paying the less or the least amount, right? Like at the end of the day, it's also like kind of like a behavioral economics thing where the user wants to think, or maybe doesn't want to think they're paying a lot, but at the end of the day, they're still like paying to the application.
Yeah, I agree with a lot of that, and maybe actually for a prediction for 2026 for Solana generally, I think we're seeing this in a lot of different ways in this kind of convergence of the way on-chain transactions or trading is kind of converging to TradFi sort of retail brokerage trading for large part, at least for these like front end kind of retail app experiences. I would expect, and I think this is sort of what we're seeing and what this piece is sort of is starting to get at least with some of this data, is these front ends still charge meaningful fees on volume. My expectation is that maybe it won't happen next year. I doubt that Axiom is going to go from 50 bips to zero overnight, and then start making all of their money through agreements with their whoever they're using to land transactions, or kind of other behind the scenes agreements. You could make an individual agreement with Prop AMM, for example, to route all your flow. I don't know that they'll necessarily make that in one step, but continuing to see this transition where the front end fees decrease kind of closer and closer towards potentially zero. And we see these arrangements become more common where, maybe you have an Axiom and they partner with Nozomi and Humidify or Solfi, or pick your favorite, Prop AMM, for example. And then they route all their flow through them, and then they have some agreement where they do a revenue share on the trades that are passed to them, and they take a kickback of the kind of the earned profit from those from that non-toxic flow that they feed them. I wouldn't be surprised to see that become kind of like the general reality for a lot of these front-end apps, which is sort of slowly stepping there, but is not quite the true state today.
Yeah, absolutely. Like I agree with your prediction, and like further expanding on it, I think it's a skill issue on the side of crypto applications and wallets that they still charge you like gas fees to transact. I think like going back to your prediction, we'll see more applications like abstract gas fees away from the end user and sort of like cover them like for the end user because they can monetize in other ways. Like a really funny story is like, do you remember Argent Wallet on Ethereum? It was like sort of like this smart wallet. They initially covered your transactions, but the problem is that like your transaction fees, but the problem is that it was on Ethereum. And when the 2021 mania hit and fees were exorbitant, they lost like millions of dollars and they had to shut down that service. But on Solana, where fees are so insignificant, like even during periods of congestion, applications could actually do that. And like wallets like Fuse already do that, right? Like they cover your gas fees for you, and like you're not saving that much, but it's nice from the end user perspective to not have to pay for transaction fees. And Fuse can monetize in other ways, like I don't know, taking a fee from like the bolts they have on Camino, for instance, and that is way more significant than what they pay on transaction fees for users. So I think like applications and like builders will get smarter, and they'll like abstract this from the end user and try to monetize by owning it and providing services that are way more valuable on top of it. So yeah, I agree with your like 2026 prediction. I think we'll see like fees abstracted away as much as possible from end users.
Yeah, I think I totally agree with that point around the actual TX fees themselves. Kind of maybe another piece to add to that, at least around a lot of these like trading applications. Blockworks Research did just put out a 2026 thesis report, and in that piece, I did talk about this concept of like all-in-one trading apps, or like super terminals, whatever you want to call them. But I think that as well is going to become a more prevalent thing where we've seen a lot of, at least in the past, like it was very common to see, a trading app that is specific to meme coins, and then a trading app that is specific to perps, and then a trading app that is specific to prediction markets. And it's very common to like, okay, we'll make this app and it's for trading this thing. And I think more and more we're seeing this realization that, these teams are sort of, in some ways consolidating, in other ways kind of like branching out and horizontalizing and verticalizing in a lot of different ways. And so you've seen wallets like Phantom, for example, onboard perps, onboard prediction markets, onboard various other services, DeFi related things. Same goes for Rabby. And at the same time, you've seen, these terminal, what used to be like meme coin trading bots, basically, the Axioms, have gone in the opposite direction, where they went from meme coins only to now it's meme coins and it's perps and you earn yield on your stables and XYZ. And I think kind of basically the big takeaway for me is that, I expect that a lot of these like singular function trading apps and singular function apps basically just disappear, and you start to lose really any meaningful edge or advantage at this point. And the real value comes from building like this kind of horizontal platform for a user where they can do any of the potential things, financial things that are available to them all in one place. Whether you want to call it like the Robinhood thesis or just kind of like an extension of where things kind of have gradually been coming in this space. I think that's something we've been seeing like slow steps towards. And then recently here at the back half of 2025, kind of an all at once moment, I would say, happened. Like a lot of the wallets very quickly onboarded a bunch of these things, and a lot of the perp exchanges very quickly like, okay, let's do equity perps, let's do commodities, let's do forex. Like I think a lot of this stuff's happening very quickly, and I would expect maybe to see a little bit more, even more consolidation and more of these like broad platforms potentially see more success, and you might see them take advantage of it in the ways that you described around, we can maybe abstract away transaction fees entirely, make it all free, and then we'll monetize you in other ways, right? We'll take a little bip here on this service, we'll take a few bips on that service, rather than having some of the like traditional kind of front end fees that people are maybe used to in this industry.
Yeah, absolutely. Now that you mentioned like the 2026 thesis around like this super trading app, I think another thing you'll see like take off is like the stablecoin playbook, but not for like crypto native users who are used to speculation, but more for like neobanking. If you think about like the fintech playbook over the past like 15 years, the main edge has been like banking relationships and like regulatory licenses. With stablecoins, like you still kind of need that because you still need to touch fiat at some point. But when you're only like staying in stablecoins, you don't really need like these banking relationships, and regulatory licenses aren't as important. So I think we'll see a lot of like neobanks use Solana as backend infrastructure and like sort of like leverage the power of smart contracts and stable coins to provide like an all-in-one neobank experience where you can like spend via your stable coins via like a Visa issued card or whatever, and like just be 100 times or 1,000 times more efficient than a traditional fintech, which is still building on like legacy rails. Whereas with a stable coin native neobank, you're building on like internet rails. So I think like apps like Avicii or like other apps on Solana or like Fuse, which I already mentioned, are very well positioned in this vertical. And I think it will be one of the standout performers in 2026, especially because it doesn't require like crypto markets to do well, because it's kind of uncorrelated from like speculative activity. It's more of like they're venturing into the fintech side of things more than just depending on like meme coin volumes trading up again and stuff like that.
Yeah, I think Fuse is a great example where I think they've really nailed that, like kind of blurring the line between dollar and stable, where it's very convenient to go from one to the other and like go from cash in a bank account to on-chain stablecoins and earning yield in kind of like either direction, right? Like you might have cash in a savings account that's earning yield versus a stablecoin on chain that's earning yield from like whatever DeFi rate maybe that they're feeding you. I think they've done a really good job at that. I'm less familiar if they've like expanded out into like more features as we've seen with other wallets. The Rabbies, the Soul Flares, the Phantoms, where it's become much more common to like productize all these different kind of like typical DeFi apps, like basically natively into the wallet now. But I'd expect that that's probably a kind of a logical direction for them to continue on, as with many of these.
Yeah. So actually, I think I really like Fuse, and I think like one of their differentiating factors is that their security and like simplified UX. I do not think that they will eventually enable like trading on like connecting to a DeFi site like Camino and then like depositing on that site. I think they're deliberately not doing that. Instead, they're like integrating products onto that like unified UX where they can monetize it. So for instance, instead of letting you go on camino.com, click like connect wallet and then deposit your stable coins on Camino, you have like a click on the app which says like earn, I don't know, 5% on your US dollars. And then Fuse or Squads, which is the company behind Fuse, has like a vault that they manage. So they're the vault manager in Camino. And that way they can earn like a percentage of the fees, like which you are depositing on the platform, if that makes sense. So it's one example of like abstracting away the complexity from like the normal user and monetizing by offering a much superior using experience. Yeah, so that's one of the things I like about Fuse. The other point that you mentioned, it's a great point on the virtual bank accounts. Like you can like deposit US dollars, like essentially, for instance, I don't have like an American bank account, but one of the easiest way for me to onboard from fiat to stables is actually sending a wire to like my virtual Fuse bank account. And then I get that in stable coins and I can just like send it to another wallet and do whatever I want. So it's great like abstraction that is actually incredibly helpful. And I don't see many other like applications doing what they're doing. So yeah, it's one of my favorite apps. I'm not paid by them by any means, but yeah, I'm a user.
Yeah, I'll say one similar app that I can think of is Sphere Pay, which I have used in the past, and is very similar in that respect, in that you can have kind of these virtual bank accounts and kind of perform transfers to those, and then have like quick on offboarding from like on-chain stables to off-chain or like bank cash, if you want to call it that. I think they've also done a pretty good job on that front. But yeah, outside of them, I think we've seen maybe a struggle, or maybe it's just slow start. Like I think you made an interesting point there around this kind of differentiation and strategy in terms of offering a kind of like well integrated and intentional design approach to, okay, let's say we do want to offer X product. Like we're not just going to let you don't just go to like xproduct.com and connect the Fuse wallet to that product. It's we'll integrate it into the app. We'll build it in natively, and then we'll have some take rate on that activity somehow. If you're earning yield, then maybe we'll take a few bips off the top of that or something along those lines. Same goes for Phantom and like their swapping and their bridging and various other things. The perps integration. I would agree. I think generally the shift in that direction for a lot of these wallets. I think what we've been seeing is that wallets have realized that they do actually have a pretty strong moat around like crypto users today, and maybe even going into the future, like maybe even like newer users that onboard. For whatever reason, we've kind of like all anchored around this idea of like having this wallet, this thing, even though it's like not really just like a wallet anymore. It's kind of an anything. It can be an anything app at this point. So just finding these different ways to more effectively monetize those users. And I think maybe the benefit that this kind of like from the get-go intentioned approach that some somebody like Fuse would have is that you might have users, longtime users of a Phantom or a MetaMask who are maybe used to doing all those things manually and not paying the extra service fee on top for the like integrated approach offered by the provider. And they're probably like not as monetizable of a user. And so, users that are willing to kind of come into your app and use your kind of like, they like the feature set. They like how you've kind of polished it all up and made it a unified experience. I don't know. They may have an easier time sort of just like in the transition towards users that just like download the app and they use everything within the app, and they're not going off on this like kind of third party adventure of, you download a wallet and then like, no, you don't swap in the wallet. You go to the website, you go to Jupiter and then you swap through Jupiter and you don't swap through Phantom and this, that, and the other thing. It could be an advantage, at least just in terms of their user base. Cause I will say personally, like anecdotally, and many people I speak to, like, I don't know, I've used Phantom, for example, for Solana, basically for as long as I've been using Solana, but I open Phantom and then I open Jupiter in the browser window within Phantom and then swap via Jupiter, not via Phantom. And probably will continue to do so for a long time. So
yeah, I do the same thing. But what I would say is that I think this reflects a divergence between applications that are building for normal users versus those who are building for crypto native users. And I think like Fuse is a great example of like an application that is building for a normal user in their minds. Whereas Phantom, MetaMask, Backpack, pick your favorite wallet, like they're probably building, still thinking about like the crypto native user because that's like their main customer today, right? And it's really tough because you see like Phantom launching new features sometimes, and then like crypto natives are complaining like, hey, this sucks. Like, why did you change it? And so they have to navigate like this fine line between still tailoring to the crypto native users, but like trying to onboard new users who are not used to the complexities of crypto. Whereas when you have a new applications, you kind of have this new freedom of just thinking from first principles and from scratch of what would a normal user want. Like they don't even want to know probably that they're using crypto in the back end. So let's just abstract away all the complexities. Let's not even let them like connect to Jupiter if they want to, right? Like that. Let's not even give them the option. Let's just like swap for them and make it as simple as possible.
Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. And maybe one last topic here that I want to talk about with you. You mentioned this in passing before we went live, but I was interested to hear that in the LST market, JitoSOL has been losing market share as of late. We do have a chart for that, but I don't know. Can you speak to this, Carlos? And like, what's the trend we're seeing here? And what are your thoughts?
Yeah, I don't know the exact numbers like from memory, but JitoSOL has been losing market share over the past few months. Yeah, you can see it perfectly on the chart here. Like from about like, let's say 35% market share to a little over 20%, which is quite significant. And in my view, the main competitor here, although you see a bunch of like tickers here, is actually Sanctum, which has enabled like various issuers to very easily launch their own branded LSTs. You have seen companies like 00, for instance, which you see here has gained a huge amount of stake, launched their own LST via Sanctum. And the nice thing is that they can tap into the liquidity of other LSTs via Santum's proprietary AMM. So, in my opinion, like Santum is one of the most probably underrated teams in Solana. They have gotten a lot of traction over the past like year or so. And a bunch of companies have used them like without people even knowing that in the back end. I can think, for instance, of exchanges like both Bybit and Binance use Sanctum in the back end for their own LSTs. Also, DATCOs are using Sanctum in the back end for their own LST. So, for instance, Forward Industries use like Sanctum to issue Forward SOL. Same with DeFi Debt Corp. So, I don't know. I don't know how many LSTs do we have on this chart here. Like on the right, we have probably like more than 10. I would say that only JitoSOL and MSOL are probably issued by their own like companies like JitoSOL, like Jito and Marinade. All of the others are probably issued by Sanctum, which is quite impressive in my opinion.
Yeah, I think this is really interesting. I wish Ryan Connor could have made it today. He would have had, I think, a little egg on his face because I recall us having a discussion about Sanctum, its product offering, and how it could ever in a million years compete with Jito. And look what we're seeing. Teams like 00 and I think Binance is the other really big one, BN Sol. And I guess if Jupiter is also using Sanctum for JupeSol potentially, those are pretty significant now. I mean, it looks like 00 Sol is as large as JitoSOL at this point. Binance Sol was kind of on track to do so, but it looks like actually some of the flow from Binance Sol moved over to 00 Sol in the recent few months. And JupeSol has kind of stayed around the same size, but it's been interesting to see like a complete shift here in the dynamics of where we kind of had, a very clear leader and winner. And it seemed like everything was kind of on the path of they'll just continue with their dominance and like gaining more and more steam because it makes sense to do so with just like the dynamics of accumulating stake and like offering good service to apps and services on the chain. And we've not seen that, we've seen a complete shift and reverse in that trend entirely over this past, 6 to 12 months.
Yeah, absolutely. The last thing I'll mention on Sanctum is that they have their own like LST, which is INF, which has higher yields than most other LSTs in the ecosystem. And the reason for that is that it represents like the LP shares of the LST pool that they have. So on top of earning like the normal yield that you will normally earn, you also earn the trading fees of all the Sanctum issued LSTs that are trading for SOL or whatever, right? So that's a really nice feature that Sanctum has. And I also think that has enabled them to keep like a resilient kind of market share in the past few months. Like if you look at like market share of just Sanctum issued LSTs, it has definitely been on the rise over the past year or so. And I think like one of the nice things about Sanctum is that as a company, you can keep like your own brand and image like to the end user, right? For instance, we mentioned the example of DATCOs. For a DATCO, it is really nice that they can say, hey, I have my own LST, for instance, Forward Industries, and I can easily deploy that in like DeFi applications. And at the same time, like maintain my mandate of increasing SOL per share, something that they would not be as able to do with like JitoSOL because they don't have as much flexibility of what to do with that like LST, right? Because it's not issued by them. Whereas here they can do pretty much whatever they want while still like keeping some like brand image and like some stake delegated to themselves.
Yeah, it makes a lot of sense. And I think it was probably, it would have been something that was difficult to maybe predict a year ago prior to some of the DAT activity and maybe even prior to some of these protocols that are now live that didn't exist at the time, like 00 is kind of a new sort of entrant to Solana as of this year. So they kind of pop up out of nowhere. But I will say, at least early on, what I had thought was interesting, at least as much as 10 months ago or so, was that exchanges like Binance, for example, were using Sanctum to basically make and deploy their LSTs on the chain. And I had thought at that time that maybe that would be a trend. If you see a bunch of all these, all the major exchanges deploy a Sanctum LST, maybe that could meaningfully impact kind of JitoSOL LST business, but didn't really seem to be the case. It was really just like Binance has kind of been a dominant one, and nothing else really moved there. But it does seem that it was kind of like the seed for something else to come, and that was DATs and basically like more services that rely on having a staking token associated with them.
Yeah, like having native stake. Like, why would you give away like stake to Jito when you can just like keep it for yourself and potentially monetize that? And Sanctum, I think like the key for them, I think it has also been not fragmenting liquidity, because if you have like a bunch of LSTs but they have like very bad liquidity, then probably JitoSOL would have remained like the leader. But by having like this pool mechanism where you can like easily swap your LST to SOL or to other LSTs, then like I think there is no fundamental reason why you would give away that power to another entity.
What's interesting is it sparks a new thought in my head around, we talked about the ETFs at the beginning of the show. I mean, you could have a dynamic where the ETFs, more staking ETFs come into play. And if BlackRock comes in and says they're going to do, I don't know what they would call it, iSOL or whatever the ticker would be, they could launch their own LST via a Sanctum, and it could be the BlackRock SOL, and you could see that grow in meaningful size on the chain, and they can monetize that directly rather than using a Jito or whoever else other provider, which would be a very interesting outcome, because I think as recently as a few months ago, the common talking point was that JitoSOL would be the best liquid staking token to use for a SOL staked ETF.
Yeah, I totally agree with that. I think like even my expectation like a year or like 6 months ago was that JitoSOL would benefit tremendously from like the ETF approval for like US spot ETFs. And then it hasn't been the case, right? Like JitoSOL has barely benefited from staking ETFs going live. I think they're just natively staking. Like for instance, in Bitwise case, I think they're staking via Helios. And as you mentioned, like if regulation like permits it, because I don't know to what extent they're constrained by what they can do, but if like regulation permits it, why not just launch their own LST and like monetize that even further instead of paying like a small fee to JitoSOL for managing that? Like I know there are like other concerns such as like liquidity, like operational efficiency. Maybe you even like bring up like decentralization concerns into this, but like at the end of the day, like ETF issuers, I think want to maximize like the amount of profits they're getting. And if this maximizes their profits, they're probably going to look for ways to like maybe a legal loophole or like try to submit like an SEC filing that permits them to issue their own LSTs via Sanctum one day. Like let's a prediction for 2026, we'll see iSOL launched by BlackRock, largest LST on Solana.
That's actually a great prediction to throw out there. What's interesting as well is that I don't know to what extent they would be prohibited from launching an LST today, but if some of the tokenization stuff comes to fruition and TradFi exchanges listing tokenized assets, I guess there's also a pathway where potentially you just create the LST, and then at some point, if you're just allowed to trade the tokenized thing on your TradFi kind of venues, maybe you create iSOL on chain, and then it's the venues become tokenized, or vice versa. Like maybe you create the iSOL asset, and then later end up tokenizing it, and then at that point it's like, okay, well we've tokenized the thing, it might as well just be our own LST in the first place, because that's essentially what we're doing at this point. Either way, interesting all around. And I think to your point, I wanted to look at the numbers around SOL ETF flows in total magnitude. If we exclude the seed amounts, then yeah, it's been like a few $100 million, like maybe $300 or $400 million in inflows since the launch of the variety of funds that exist. Largely, the Bitwise ETF is the main contender there, with over 600 million total, with 200 million supplied at seed. So yeah, I mean, if they were using a Jito or whoever, you'd expect to see that show up in kind of the top line or bottom line, like growth of the liquid staking token. But I don't believe that we have seen that, to your point.
Yeah, I think it was around $550 million in net inflows as of November 30th. So like once we have the entire of like December data, I don't have it at hand, but it's probably like, I don't know, this month hasn't been super strong in terms of inflow. So let's call it like 600 million in cumulative ETF inflows. It's still like significant, right? And I think it has like the potential to be beneficial for one application within Solana if they can somehow leverage that for like their own OSTs or whatever going forward.
Yeah, and maybe one last piece here. Something that could be interesting as well is that typically you see a little bit of jockeying around the fees charged on these ETFs themselves. So, for example, like Bitwise, it's 20 bips. Fidelity, it's 25. VanEck, it's 30, according to farside.co.uk, the crypto ETF tracker website. So if you were to issue your own via a Sanctum-like offering and have additional way to kind of monetize that natively, you could then also potentially offer a significantly lower fee on the product itself. So the sort of the asset, you might charge 10 bips instead, and then maybe you monetize a few bips from kind of the offering the staking token yourself and taking a little bit from the operation of it. So yeah, different ways to potentially like kind of operate and play that game if someone, if the ETF issuers were to come in and experiment with issuing their own. And perhaps they already are. I don't really know. They might be behind the scenes right now thinking about it.
Yeah, maybe, yeah, last point, like you've already seen kind of this game, like we were talking about like abstracting fees away from the end user. You've already seen it like, for instance, with European ETPs, where sometimes staked ETPs do not charge fees on assets under management, which is like the usual way ETFs monetize. Instead, what they do is they say, hey, this is like a zero fee ETF, but they will take a cut of the staking rewards, right? So they're monetizing more from the staking rewards, because for something like Solana, that is like, I don't know, 6.5%. So imagine they take like 1% of that instead of like the usual, like, I don't know, 3% management fee. Probably the math that didn't make sense there, but like whatever. That like the point is like they're monetizing the staking rate instead of like from the usual management fees, and yeah, that can also be good for like the end investor.
Yeah, the one thing there that might be a caution that I'm uncertain about is the regulatory aspects of it, at least within the US, of offering a product like that. And again, creating your own LST and then offering your own staked asset ETF based on your own LST. I'm not entirely sure on that one. So maybe it wouldn't quite be possible in that direct manner, but maybe it would be possible via a partner or something of those sorts. So maybe need to dig into that idea or concept a little bit more, or see kind of where the regulation is sitting today. But interesting all around. I think that was kind of a surprise point of interest for me, at least, to kind of see the shakeup in the LST side of things. So I'll be curious to watch that going into next year. Can Sanctum kind of like, and these various, like, it's not really Sanctum, honestly, when it comes to like the front end view of the data. It's like 00 and Binance and Jupe and these other apps. Like, will we continue to see more of that, front end or like protocol related staking token take off in comparison to, the dominant JitoSOL provider that has, been dominant till today. But awesome. Thanks so much, Carlos, for coming on today. We lost you there for a second. I was worried I was going to lose you for the closeout. It was great having you on, great chatting. And I guess hopefully you enjoy the new year. I think the research team may actually be working tomorrow, New Year's Eve, but hopefully you can have some fun the night of or the next day for the new year and enjoy some time.
Yeah, likewise. And I don't know when this is coming out, but likely in 2026. So happy New Year's to everyone.
Yes, good call. It will be in 2026. So happy New Year's to all the listeners out there. You'll see much more and hear much more from us in the new year. So until next time, thanks so much.